12 months for, growth stage companies has been really hard to raise on equity, raise a round, especially like a growth stage round. And, in all of this, what we're forgetting, it's okay to say, hey, we're just gonna, it's selection and it is what it is. Yesterday Vivek Ramaswamy was like, well, they shouldn't have put their money in Silicon Valley Bank, which I was very, as many may remember, very pushed back quite hard, because that is just a random act that is affecting them, and it's not thinking about, in my opinion, the bigger picture. When you're talking about these founders and their companies, if somebody, especially in more traditional sectors like healthcare, when somebody leaves those, leaves a health system or a big biotech company and comes and works for a startup, that's a pretty big change for them. And so, there is a humanity to this that we're not talking about at all. And again, looks like, Mario, that where we're going to see something happen that's going to get these people back to normal. But without these payrolls, payroll, again, is a reminder for people, in the US, payroll is collected on is 15th and 30th, and 15th, as a reminder, is this week. And so, if they don't get their money on Monday, we're in a lot of trouble.
I want to ask a question, Matt. This one, I'll go to you. And we do have speakers that will be joining us in a bit. So prepare some questions for them. Danish, I'll send you through the speaker list that we have for the next few hours. But Matt, the question I have, if we do get a bailout, we're seeing crypto rally. We'll see what happens when the markets open on Monday, tomorrow. But do you expect business as usual next week? Or do you still expect, because of the fear, that contagion will continue?
Again, back to the assertiveness of how they handle it. I think that the part that has changed, I mentioned this yesterday, is that so many of these companies relied upon the line of credit that was being supplied by SBP to project their runway, and that's gone. And I don't have the. I would be great if somebody could dig up the quantum of how much was in those lines. I'm sure we can figure that out. But that's a lot of runway that just evaporated. So behavior is going to change. Number two, there were tons of funds that had billions, tens of billions of dollars tied up at the bank as well. Those funds are going to be pulling term sheets. They're going to be paralyzed for a period of time, regardless of what happens here. And so that's going to freeze up. So there's going to be knock-on consequences no matter what. But those are secondary, because they would have been happening anyway with the recession coming. Somebody said before, and I think they're right, recession solves a lot of the problems, conversely, actually, with inflation. So those things I look about, they're pulling forward what ultimately would have happened. So it's first is, can they stop the contagion? And two, regardless, there's been a fundamental change because of this.
I'm just going to bring up Mike McCarthy is coming up now. Danish, I'll just do an introduction very shortly. But I want to go back to name redacted, man. Anything to add to the discussion?
No, other than that thing I found on the FDIC, that they've done this in the past, where it was a 2-year program to allow unlimited protection as a way of ensuring confidence in the banking system. I'm not as concerned personally about seeing a run on banks this week. I think this was a specific situation where you had large high net worth individuals and companies or VCs pulling their money out of this specific bank. But I know there's debate over that. I get where Kim's coming from, and nothing more for now. There's a lot of news. We're going to get this is such a fluid situation. We're going to be getting a lot of headlines today, and I'm still wondering if the regulators, Yellen or Powell, are going to give a press conference before the market opens. Because I think
we know they're going to do it today for sure.
It's 11:30 and one today as well.
Okay, good. All right.
And as an interesting point here, a lot of talk about moral hazard, but if a bank ceases to exist and only the depositors are made whole, could this cause a bigger hazard than the moral hazard we keep talking about? This is a good question from the audience.
Moral hazard is very important. We don't want 2008 to happen again. But when you look at some of the programs that actually happened in 2008, you look at the TARP program, even the shittiest of the shitty banks, returned the money from the TARP program and paid the US government tens of billions of dollars in interest. So I know we talk about, we bailed out the banks, But I don't think you guys realize all the convertible preferred securities that the U.S. invested in those banks were paid, and the U.S. actually made a lot of money out of the bank bailout because the U.S. essentially became a distressed investor.
But, ultimately with moral hazard here, is the moral hazard here is if we actually bail out the shareholders, right? Getting people their deposits.
You can wipe the shareholders. I agree. You can wipe the debt holders. Just make sure that there isn't any contagion.
Can
Kevin, I know you've had
moral hazard. What exactly do you mean by moral hazard here?
That if we make a decision today, we're going to have to live with that decision over time. I mean, that's really what the underlying point here is, that if we make a change today, that change will last over time. But I wanted to pivot to is your audio working now, Kevin?
I think so. Does this sound okay?
Oh,
that's perfect, wonderful. Man. It's perfect. Yeah, we're just going. It's been like 20 minutes, me and Kevin trying to sort out the technical issues in the background. So I'm glad it worked.
Thank you for that.
Ooh,
sorry.
Kevin, how are you? Very
good. Thank you for having me here.
Man, what are your thoughts on what you're seeing today? Maybe Dan, I'll give you the mic. But what's your thoughts? Just a quick overview. Not sure if you heard our discussions yesterday with Bill Ackman and who else did we have? Bill Ackman, Jason Calacanis,
Mark Cuban.
Mark Cuban. Mark Cuban. I'd love your thoughts on these discussions and the announcements we saw today.
Yeah, absolutely. I think it's very important, unfortunately, that depositors take at least some level of a haircut, because there does need to be a message sent that ultimately there is a risk that you have to evaluate when you have your money in a bank. For example, I have a real estate startup and we had our money in a community bank a month ago. And I thought, the last place I want to hear about risk is banking. So I'm going to move that to one of the big four, because I know the Federal Reserve will always backstop the big four. At least I believe that, and I'm willing to make that bet. So I moved my money to JPM a month ago, and I'm glad I did that. Now, it's unfortunate, but unfortunately, what you have is if you don't have depositors take at least some haircut in an uninsured level here, what you're essentially saying is everyone is 100% insured at every bank. Now, banks are actually incentivized to continue the risky practices like the lack of hedging for interest rate risk that happened at Silicon Valley Bank. You actually end up with potentially a greater crisis in the future. Now, I've been listening to the conversation, and I specifically wanted to point out Jay's comments, because Jay did mention, look, you don't need that much of an FDIC backstop right now if you just say, hey, look, we'll backstop 100% of the deposits. I actually think that's a mistake. I think somewhere between a probably 10 to 15% haircut is unfortunately a lesson that we do need to have some risk management when it comes to where we bank, because we, after all, as customers benefit from the risks the bank takes. So we should not freely benefit from that. If the bank gives us easier lending,
you don't benefit from the risk that the bank takes as a depositor. You don't benefit at all from the risk.
Let me explain that. You actually do. The reason you go to a smaller bank is because generally they have better interest rates or looser underwriting requirements. Therefore, you as a customer of the bank completely benefit from the risk measures the bank is taking. If the bank is taking less risk measures, you benefit as a depositor. Depositors are not scot-free here, unfortunately.
But actually,
I think in the case of SIVB, depositors were making 0% interest, so they did not benefit, but they did benefit from the loan side.
Yes.
I was going to say they benefited because if you look at a lot of the people who were depositors, and that 97%, they're the companies that were able to get lines of credit that they couldn't have got at the major banks. That's just a fact.
And so, as you were talking, I was thinking about it, and I was because I also am a founder and we have money in banks, and we happen to be lucky not to be an SVB. Like you just mentioned, you weren't. But, if you're a founder and you're thinking about your company and your startup, should you really be focused on your risk profile? You're telling me that bank run was on the list of things that you were worried about?
I'm a brand new startup creator, and the last thing I want is any investor in my company thinking there's any risk. And so I thought to myself, if there's even a 0.1% chance risk that this local community bank I was using has any kind of even slow movement of assets, even if there's protection, but I lose access to my assets for a few weeks, even if there's a 0.1% chance of that, I don't want that chance. I'd rather have Jerome Powell on my side and be at one of the big 8 banks that are properly stress tested unlike a local bank like SVB. Now, unfortunately,
But
sometimes we
Kevin,
have to go
SVB,
with
I'm
local.
so sorry. I wanted to push back a little bit. This is the beauty of spaces that we can do that. SVB was one of the 15 largest banks in America. It's like number 12. It's not like your
Yeah,
local community bank.
right, but here's the thing. Remember that in 2015, they lobbied to essentially ask the government to raise the standard of what an SIB is, a systemically important bank, and they contributed to essentially the raising of that limit from 50 to 250 mil. Them sitting at 211 billion in assets puts them under that level. And I also take issue with this idea that Ro Khanna mentioned this morning. The bank was fully capitalized. I mean, if I go into their Q4 financials, I take out intangibles for liquidation, which of course you're going to do that, and you look at their mark-to-markets, you're already insolvent as of Q4 of last year.
You were already insolvent. Yes.
Yeah.
That's right.
Can I represent the great Mr. Wonderful on this Spaces, because he's on a plane right now? But we've been texting for his view. Is that all right if I jump in for a second?
Yes, go ahead, Matt.
All right. So he hold on a second. He tweeted out a second ago, and then I asked him for a follow-up to see what he meant. He put out basically, the combination of a negligent board of directors with idiot management is the potent cocktail that led to a disastrous outcome. Why should taxpayers bail them out? The lesson is simple. Never put more than 20% of your liquid assets in any one financial institution. That's what he tweeted. So I texted him, just to be clear, you saying you wouldn't backstop deposits. And he wrote, no backstop over 250K FDIC insured limit. Otherwise, you perpetuate idiot management in banking that makes stupid mistakes like SVP did. So
and Mr. Wonderful knows a lot about losing money. So
I'm just saying, I'm just representing as the fine man who was just speaking. I'm sorry, I didn't realize who that was, but intelligent counterpoints offering the endorsement of Kevin O'Leary for your view.
But guys, can I chime in here real quick?
Go ahead.
I just think it's completely wrong to put the blame on depositors and say they should have done a better research or diversified themselves better. We're talking about a bank here and not a small bank. And depositors should not have to worry about these things. The fact that a bank can even lose depositors' money, that is what is systematically wrong here. And that needs to be fixed, because depositors need to be able to trust that the money that they put into a bank is safe. Anything else is outrageous to say that depositors are at fault.
I want to link to Tim's Matt. I want to link a question to Kim's point. I want to add a question to you, Matt, and to Danish, and I'll give you the mic back, Danish. But why were depositors using Silicon Valley Bank? What were the advantages that SVB offered?
So
that's why it's a
Matt,
good.
You can go first.
It's why it's an important debate to have, because the honest, realistic answer is that this particular bank targeted this sector to go ahead and create a very big bank. And that's why they ended up with whatever 190 billion in deposits, and it's because they were very founder friendly to this particular sector, and they extended lines that other banks would not have done. Generally speaking, in my experience, looking at founders, and they were also very founder specific friendly, enabling them to borrow against equity. A lot of founders had different financial relationships with them, so they just went after their sector. So I do think the number one moral hazard argument would be because somehow that behavior beget the situation, but that's not the case. What beget the situation is that the FDIC has a public policy of ensuring a certain amount of deposits in order to prevent a bank run like that. So why would they allow, pursuant to their regulations, 97% of the deposits, that concentration, to be uninsured? So at the end of the day, this is a failure largely of regulation. You're punishing the wrong people. But the best counter argument would be, well, you were into this bank because there were special benefits that other banks wouldn't confer, and you should pay some type of price. But I don't think that's on balance. It's not realistic to think that we can outsource risk management in terms of diligencing your bank better than the government can. We expect the government to be able to take that role.
And to be completely fair, Kevin, if we took your approach, it would stifle innovation in finance, in banks in general. I mean, if everybody did what you did, we would only have 4 banks right? Everybody, it would just keep going up the chain, which would
100%.
be
That was my point last
disastrous.
night.
Yeah, it would be disastrous for the economy, and it would be disastrous for projects across the country. I mean, Bill Ackman was here yesterday, and he was spot on that a lot of small projects rely on these community banks because the big banks don't do them, not out of the risk of it, but out of principle. It's just not worth their energy or time. And so, what do you say to that argument? That are we trying to kill community banks? Is that what you're saying is the right move, that we should have concentration of power to the big banks?
Well, I think these are very good questions, and it's an extremely fair counterpoint. I think the important conclusion here, in my opinion, is the federal government and regulators need to lower the standards for stress tests to all banks. Now, unfortunately, to some degree, that is going to reduce innovation. That would be very normal. But I don't think if we subject the largest 100 banks to stress tests that we're suffering such a terrible risk to innovation that we have any problems, and now we can walk away from individual customers having to worry about that due diligence, like you all have mentioned.
But if everybody does what you do, we will have that problem. I'm sorry, I'm getting lost here. Which
That's
is
fair.
only for certain people that's okay, but other people should rely on the community banks. Sorry,
No.
we're just having a conversation here, but it's just because this is the question. By the way, the number of family members that have reached out to me, just to give people context, people use smaller banks all the time, just like you did. And so, if everybody has the same question, then that's bad, isn't it?
It is to some degree.
It
You're
is.
right initially, but what happens is in my opinion, you say, hey, look, systemically important banks, set the limit very low, set it at 10 billion. Yes, it's going to be more expensive, but that way you could have a top set of 200 to 500 different banks. You'll have plenty of innovation amongst those. Do I think there should be an oligopoly of banks of only 4? Absolutely not. But do I think we need regulators to actually regulate, and that companies as large as SVB should not be hedging interest rate risk? No, absolutely not. That's terrible as well. So yes, we do need local.
Couldn't we do both, Kevin? Couldn't we also take care of this current situation, make sure that we don't have other bank runs, and reduce the bar and the threshold for what is systemically important or systemically critical?
Potentially, and I suppose that'll be ultimately up to the regulators and how they want to balance the potential aspect of, hey, look, here's our taxpayers now bailing out a Silicon Valley bank, right? The name certainly doesn't help itself, but that could create some populism issues. Some might argue there might be some inflationary issues, but then again, frankly, the Federal Reserve is tapering to the tune of $90 billion. I don't think per month, I don't think the shortfall here would be anywhere near that. I think you're probably looking at closer to maybe a $50 billion shortfall max if you look at sort of fire sale pricing, maybe 25% haircut. But yeah, of course, the correct answer is probably a balance. But should every single depositor absolutely be guaranteed and basically spread that to every American taxpayer to 100% when they full well knew that they were only insured up to $250,000? No, because that does send too much of a signal to the entire banking community that you could do whatever you want. And don't worry, the government will come in and bail you out. It's like having an accidental damage protection plan on your iPhone and then taking selfies on a roller coaster, because if you drop it, you don't care. It increases and encourages recklessness. And that's the last thing we want to do.
Hold on. So there's already been a solution that's come up, which is to create another version of an FDIC and another insurance pool for uninsured deposits. We're all talking about whether the taxpayer is going to pay for this or not. And to be very honest with you, the damage to the economy is likely to be much worse if you have several banks go down overnight. And I will tell you from experience that in a fractional reserve system where banking is based on confidence, you could actually have good banks go bankrupt. Actually, decent banks that take good risks, that have 90% of their liabilities as deposits, because of the illiquidity of the loans on their balance sheet, you can actually have good banks fall for no reason. So I think that is being left out of the conversation. And you don't need a full bailout. You can actually have banks contribute to a new insurance fund and pay into it every year. Initially, the government backstops it, but in the end, the banks pay for their own insurance.
And to be fair, if we force everyone to go into a smaller pool of banks, this whole concept around 250,000 in FDIC. How are you going to take some as a startup if you have 10 million in the bank, which at growth stage is completely fair? You should have money in the bank because your burn is high and you're growing. Are you going to now take it across, how many is that, 40 different banks? There might not be 40 banks to give it to. And how are you going to manage your payroll? How are you going to measure? Because again, for a lot of companies, 250K can represent one payroll. And so, I think that we just have to have more common sense solutions here, focus very clearly on how do we solve this problem right now? How do we prevent a bank run? And, and I can't believe I'm saying this, but the solution that I'm seeing from the government right now seems to be along those lines. It's insane to say that they're acting. I still think that they should be more certain. Kevin, are you seeing amongst other founders?
Hold on. There's just a bit of breaking piece of information from Mark Kleinman from Sky News. A deal's not yet certain, but I understand that both HSBC and JP Morgan are exploring buying Silicon Valley Bank, UK.
Yeah.
Okay, for the UK.
Oh, Silicon Valley Bank UK.
Yeah, I read that at the end. Yeah, Silicon Valley Bank UK. I thought it was Silicon Valley Bank, which was a bit surprising.
Yeah, you buried the lead. Everybody's like, hold on. JP
yeah, I know. I read it at the end, so I was like, I thought it was major news, and I read it. It's just UK. So
well,
still
it's better than Bank of London. It's better than Bank of London, that's for sure, because it's a bank that people know. I think that
JP Morgan saw Bank of London going in. They're like, okay, hold my beer. If they think it's worth something, we think it's worth something.
What's interesting is, and people may not know, but Optum banks with, I just heard this morning, banks with Silicon Valley Bank London. So that's not a bad account to have. I wanted to, really focus in on the response from the government. I know that they've, Janet Yellen went around and talked about this. I asked the team, if anybody here actually knows Representative Ro Khanna, please do have him join. We had, Thomas Massey come in and give the other side of the argument. I'd love to hear Ro Khanna's side. So if there's anybody in the audience that can ping him, that would be great. I know our team is reaching out as well.
Yeah, and if you do, and something to mention to the audience as well, I should have mentioned, if you do recommend any speakers, anyone at all, please do DM me, and the team is checking all the DMs that I get, and we'll be able to invite them and add them to the schedule. So yeah, Mike is yours, Danish.
Yeah, so as we're looking at the response, Kevin, I heard your thought on the response here, that ultimately there should be a little bit of a haircut. That, and I'm going to use my words, and I apologize. I know that's not probably what you meant, but we have to have some people feel the pain here, because while they benefit from the banks, just like they benefit from the bank's decisions, they need to also feel the brunt of what happens when they don't make good decisions, and there should be diligence. I'm going to ask you a tough question, but this is an important question, and I know you're ready for it. But when you switched over banks, how much diligence did you do outside of just the fact that they're too big to fail?
That's the only piece of information you need.
That's the only piece. But remember that they nearly did fail previously in 2008.
If you're investing in America, I think the rule of thumb of don't fight the Fed is probably the most important thing to consider. And so I'm a big fan of believing that, and I think that simplifies a lot of the work.
And with your work in real estate, do you feel like the Fed is the source of this problem, or this is just bad leadership and bad management?
No, I mean, well, it's a combination. I mean, ultimately, this is by design what the Federal Reserve is trying to accomplish. Job losses are exactly what they're predicting. And as much as it's painful, and Jerome Powell seeks to limit pain, as he said, because of the economic and human consequences, that's an important word, considering the fact that people suffer. Suicide goes up in a recession, right? People losing their jobs and their livelihood and going bankrupt is very, very bad. But unfortunately, some of the pain of people losing their jobs and businesses going bankrupt bankrupt has to occur in a recession. And ultimately, that's what capitalism does, is capitalism essentially creates recessions through a business cycle, which can be amplified by the actions of the Fed, which they might be doing the wrong thing at the wrong time. For example, why were we printing money in March of 2022? That was absolutely the wrong thing at the wrong time. But we could criticize the Fed going backwards all we want. What we need to do is look forward. Yes, the Federal Reserve is creating this sort of environment where the riskiest of assets do face potentially going bankrupt. But that is a normal, dare I say, feature of capitalism.
Is the next step, so they wanted to do this until something broke. I think something's broken. Are they done? What do you suspect? What are you preparing for?
I mean, ultimately, I don't think we're going to see. I just had dinner with Kathy Wood, and I asked her specifically about it. I think sharing her perspective is interesting. She mentioned she doesn't see the risk of Silicon Valley Bank as systemic, but there will likely be others. And I echo her opinion that no, the pain isn't over. But do we think that this is the moment where the United States dollar loses world reserve currency status and we default on our debt? No, I don't think we're anywhere near that. Look, all currencies that have ever existed, all fiat that has ever existed, has always gone to zero. Eventually, that reckoning will come to America. I don't know if any of us will live that long to see that, but I certainly don't believe, along with Kathy Wood, that that's this cycle. But yes, will there be more pain before the cycle is over? Absolutely. This is just the beginning of that.
But yeah, I do disagree with that, though, because we are living in different times and evolution is accelerated, technology is accelerated, and what's happening to the US dollar will also be accelerated. So you can't compare what happened in 200 years ago to what's happening now. Things are much faster, and you can already see it in the last couple of years how things are changing rapidly.
You know, it's fascinating because I'm obviously, I agree with Kevin that I don't think it's going to happen in this cycle, but these kinds of decisions are making me very suspect. I mean, going up this quickly, and do you think that we're using outdated information? I know the jobs report just came out. You know, we're trying to break. You just said it, so I'm going back to it. You said, well, limiting the pain. The goal is we do need to see some level of job losses, but isn't that a lagging metric? I mean, we've seen prices of commodities start to come down now. Are we just working with old data, and are they going to end up overcorrecting? I mean, one question that's come up, last point on this and question on this, are we overcorrecting? Now I think consensus view is that there's going to be a 25 basis point move, but is that too much still?
Yeah, it actually might be. So I think there's a greater likelihood of a 0 than a 50. It's all going to be predicated on CPI coming out on Tuesday. That'll be very important, of course. But if we have even a CPI report in line or slightly low with expectations, there's a very real likelihood of 0 because, yes, there is a risk of overcorrecting. I personally believe, much like Jay mentioned earlier, that I completely agree, the disinflation is already here. There is no wage price spiral. There are a lot of folks in markets who have been, especially in the last part of last year, pricing in the actual fear that Jerome Powell might turn into Paul Volcker and purposefully push us into a deep, dark recession with a 10+% interest rates. I think that fear is way overblown. Yes, the wage gains we have right now are in retail hospitality, but that sector is still substantially underemployed than it was in 19. Healthcare is equally employed today as it was in 2019. But if we were looking at trend, we need another 900,000 healthcare jobs. So of course we're still going to have job growth here. So yes, absolutely, job growth is completely a lagging indicator, and the likelihood of the Fed overcorrecting is absolutely there. The good news is, if we read earnings calls from corporations, whether it's Johnson & Johnson, Target, Walmart, Tyson Foods, or really any company, what we're finding is the focus now is not raising wages any more than the catch up we're seeing of the miscellaneous wage increases like Walmart or whatever. The focus now is productivity and efficiency and automating, because they realize they can't afford to pay employees anymore, and employees are starting to lose pricing power. One last point on that. Read the Cloudflare earnings call and you'll see they mentioned for 1,500 jobs, they had 4 100,000 applications. Wages are no longer facing a wage price spiral risk, and that is good for preventing a Paul Volcker, and the Fed will realize that.
Hey, just wanted to, thanks, Kevin. Just wanted to welcome Dennis.
Yeah, I'll introduce. Yeah, I'll do that. I do want to mention one interesting comment that the Silicon Valley Bank's Twitter account is gone for anyone going to look through their tweets. So they did delete it because there's some interesting tweets, reading them through days and weeks before they close shop. There's an interesting comment here I'll read out from, I don't know if they want me to share their identity, but I'll read it out. I'm in the spaces. I think it's to reset on the fact that Silicon Valley Bank doesn't have the assets to cover 50 to 75% of the deposits. So this isn't a case where those above FDIC limits lose all of their money. If the government comes in, it's to fill the gap of a portion of it. This portion's to be determined. So let me see if I should read out the rest. Okay, so we aren't in space where companies aren't making payroll once access is given anymore. The debate is on the debt facilities that company is using. So Dennis, good to have you on stage, man. Would love your comments on what was discussed so far, and I appreciate you giving us your time.
Yeah, thank you so much, Mario. And thanks so much to everyone who is putting on this conversation, because it's quite helpful and quite illuminating. And just a couple quick points. First, the debate about the desire in the rest of the world for U.S. Treasuries, whether it's strong or not, between Kim.com and special situations. Well, both gentlemen are working with different data sets, and no lies have to be involved here. And this is what makes a trade. But the fact is, if a crisis happens, especially if it starts in the U.S. and spreads to the rest of the world, as we saw in 08, 09, the fact is the rest of the money in the world will flood right back into the U.S. That's why U.S. Treasuries, as someone pointed out, a special situation,
100%.
fell 40 bips in a single, a matter of hours. So even in a meltdown, the U.S. is the best house in a bad neighborhood. Next is that I keep hearing moral hazard, and this worries me, because in 08, there was that. And I love the high-level explanation of moral hazard that you gave, but really what it is that we're afraid of bailing you guys out here because you messed up. And if we do that, then other guys will mess up. Exactly. And they'll take more risk because they know they might be bailed out, so we can't do that. So what happened in 08, 09 is first Bear Stearns wobbles, so the U.S. comes to them. Then Lehman wobbles, and the U.S. decides, dude, we can't keep doing this. Moral hazard. They don't bail them out. Later, after all was said and done, it might have been $6 billion difference between all of the swaps, et cetera, et cetera. This bankruptcy judge, I heard her later say, Lehman was never really bankrupt at all. It was just that fear thing. Okay, so they did all that. Government blew it. They wanted to play hardball. They blew it by not guaranteeing Lehman. All government has to do here is step in and say, we guarantee depositors. Depositors did not commit huge risk, nor did this bank really. After 08, they were forced in the reforms to no longer invest in ridiculous synthetics and CDOs and mortgage-backed securities created for no other reason than allow someone to short them, and all that crap went out the window. And instead, you put it in safe government securities. And then what happens? They do, and the Fed comes along and raises rates so high, so fast. It's not just 400 basis points. It's a 13, 14, 1,500-fold increase, really, in borrowing costs. And then those bonds lose over half their value suddenly. And if no one ever had to sell them again, and there wasn't a run on the bank, this wouldn't have happened. There was no risk-taking here that was out of line.
So
Yes,
Dennis,
the bank
sorry,
blew
just
it.
want to make sure that we get your thoughts on this, because I'm hearing something and I want to confirm. You don't think that the leadership at Silicon Valley Bank, they were working with the crappy cards they had, that they were not at fault for this meltdown?
Look, anytime a meltdown like this happens, the first place we look at fault is within ourselves. Yes, it is the leadership's fault. I talked to a senior guy at one of the biggest banks in the world that you guys have mentioned just today, who pointed out that, listen, the fact is we took $1 billion hit on the same type of stuff. We took a $600 million hit and another $400 million hit. We were writing off as we go. And SVB didn't do that. They saved it up, hoped they could get out. And then ultimately they did it all at once and took the hit. But when they took the hit, guys, it was less than $2 billion. It's 1% of their $200 billion in assets. All right, yeah. They blew that, but it was instead the run on the bank that caused it. They lost $42 billion in deposits in a matter of 2 days. It's 20% of assets. JP JP Morgan could not survive, could they? That kind of confidence run if 20% of assets were pulled out in a day?
Well, I mean, it's a fascinating question, which is, we were just hearing from others that, well, that the Fed is behind certain people, and so you should feel comfortable. You're scaring me a little, Dennis. So I want to make sure that I understand your point. Your point is that this was a bank run, the bank run, or this was the Fed. The Fed raised too quickly. They had invested in securities, long duration securities. Perhaps there was a mismatch. I mean, there was a mismatch. That mismatch then led for
That's so cool. You could track that. What are you getting?
Right. They didn't tend to it right. Yeah, keep going.
Yeah.
Well, all I'm saying is that the problem was created by the Fed itself, and now the Fed's going to come in and act like the banks did something wrong. They were ordered to put their money, their cash, their securities into what is the phrase you guys must know? High quality reserves. And that was government-backed securities, which were really safe until the Fed went out there and made them lose over 50% of their value in less than, 9 months?
So
the
now,
very fact they raised that much says they got it wrong.
Yeah, so Janet Yellen is out there. Ro Khanna is out there. They're talking about, doing the right thing, making sure that people get their deposits back. No bailout, which is good. I think everybody agrees that the shareholders should lose in this. It's their job.
Yeah, the shareholders, definitely.
Yeah.
Jim
But
Cramer
not the people that put their
recommending
money
the
in
stock
the
at
bank.
300, poor guy.
Yeah. And then,
not the depositors. And now, yes, the depositors also are to blame. If you are Meghan Markle and Prince Harry, and you had 100% of your cash in that bank, even though FDIC guarantees only 250K, yeah, that's partly your fault. Just like when Bernie Madoff ripped off Kevin Bacon and Kyra Sedgwick, they had all of their assets with Bernie. That was a mistake on their part. There's always enough blame to go around. I'm just saying that if you think about it, guys, would any of it happen without the Fed raising rates so far, so fast? And guess what happens then as a result? Look what happened to the treasuries yesterday, or the day before, with the 40 basis point drops. Interest rates go down off of that base, and that's the opposite of what the Fed wanted. And so now what are they going to do? They're really in a crunch. I don't think they can raise here, or certainly it can't go 50.
So you think they're going to raise 25 or 0? I mean, 25.
I think they should. I think they should pause and go 0 and just say, we really have to hold back on this.
Interesting. Name.
But one other thing, can I hear like special situations respond to this idea? Because I said this on CNBC at the time. I came up with something at the time that I called the Rob plan, based on a friend of mine. He said a government guarantee, just promising people, look, like if we'd come in and said we're gonna back these mortgage-backed securities, okay, we'll make it. Don't worry. It would have stopped the panic that spread because of Lehman.
So we
and
actually
here,
do.
A guarantee is a low-cost solution, isn't it?
I think it's a low-cost solution, and you can actually do it in a way that doesn't actually affect the U.S. taxpayer in the long run. And by the way, when it comes to mortgage-backed securities, they actually are guaranteed by Ginnie Mae, Freddie Mae, and Fannie. So that's a separate issue. But when it comes to the solution for uninsured deposits, there's several ways to go about it. And the easiest way to go about it without actually affecting the U.S. taxpayer in the long run is to set up an insurance entity like the FDIC, but for uninsured deposits, where banks pay, 0.1% of income or 0.2% of income, or whatever the government agrees on with the big guys, right? JP Morgan can afford to, to put in 100 million every year, and all these banks can contribute so that it's going to benefit all of them. All their stock prices are going to trade higher. All their debt's going to trade tighter so that when they borrow from private investors, those yields are lower. And in the end, it actually will probably benefit the entire banking system. And guess what?
Don't you think they just
nobody has to put any money into it?
Yeah,
nobody has to put any money into it. It can all be paid back.
Jay, you're assuming that the banking fees are not going to be pushed over to consumers, right? That's the underlying.
Oh, give me a break. Guys, I mean, do you know what the profit margins are on the big banks? They're not going to these. And by the way, do you know how much it would cost to actually, with the $18 trillion of deposits as a percentage, how much, even if it was put on consumers, how much it would be? Almost nothing.
It's de minimis. It's really nothing. I was surprised to hear the Congressman Massey, who was a great guy, for coming on your on your spaces. But I was surprised to say, well, I guess it could cost 20 billion if there were some kind of bailout. But then, where's the money going to come from? Hey, guys, you sent 100 billion to Ukraine, no questions asked. You found money for that.
These are
You
the
put
types of
out
things I'm talking
trillions
about.
of
Like,
dollars in
we have all this
COVID
pork belly
relief.
spending going to like parks and all these local Congress
So that's just bull.
representatives.
I do worry, guys, that I love Hank Paulson of Goldman. I thought he did an amazing job as Treasury Secretary. He was underrated and underappreciated at the time. But if you look back, we were so lucky that he was in there, and Obama was kind and smart enough to let him stay in there and keep going for a while. And he did an amazing thing. But to have Yellen there, who spent more time kind of shilling Biden policies for liberal stuff and diversity and inclusion and but yet not. I felt like her statement today on Meet the Press was poorly handled, jumbled, unprepared, unsophisticated.
That was the first time that I heard Janet Yellen, in my opinion, be that clear. I mean, I thought
wow,
incredibly clear.
Wow.
So I'll walk you
Different
through
views.
why. Every word seemed prepared. She didn't use the word bailout. She did not use the word bailout. She talked about shoring up deposits. She couldn't say what's going to happen exactly. I felt like that was good execution. Dennis, you clearly disagree.
I thought it was kind of halting and not declarative enough, not reassuring enough. She could have said things like, you know what, this is a great regional bank that did a great job for a long time. They got out over their skis, but we don't see it as systemic because of this and this. I felt like she could have been a lot more confident and reassuring, and that we have a plan. We ain't telling you what it is, but we got a plan and it's already underway. By the way, can I say one more thing? And you've been very kind. I apologize for filibustering, but Elon Musk, message to Elon Musk: buy this bank. Use it to turn Twitter into X.com, the finance app. Use it to become a hero in Silicon Valley who hates Elon Musk for doing the Twitter files and revealing the censorship of conservative views, horrors. Use it to, then regulators will love you for coming to the rescue when Washington hates Elon Musk because
Musk needs a banking charter. So he needs a banking charter. And
Boom.
Twitter itself has about 1.5 billion of interest and is currently free cash flow negative. Musk himself said at the recent,
he's got other things to worry about right now.
right. Musk actually is trying to get Twitter to break even by the end of the year. So they don't have the ability nor the bank charter.
I'm just saying this would be nothing. This is really is the $2 billion spread. Really, if you get right down to it, all it is that $2 billion spread. Well, there's 15 billion also that are underwater on the hold to maturity, but I think the Fed will stop raising and that'll come back around.
And again, I think it's a natural response for a lot of us to say, well, Saint Musk will come in and fix this. And, I think he's done that enough recently.
But also he could use the bank. He needs a bank charter. I think actually it's not a bad move, and it's selling for cheap.
I mean, that might actually be true. Name, did you have a comment on what Dennis said?
Yeah, I wanted to add to what Dennis said. And if we want to talk about moral hazard here, that starts right at the Federal Reserve, okay? Because historically, the Federal Reserve has a tendency, we have seen this before, this is not the first time, where they will keep easy money policies in place for too long, which creates excessive risk-taking and leveraging into risky products. It creates bubbles. And then on the flip side, when they have to become more restrictive on policy, like now, we had ZERP and QE for like 15 years pretty much, which pretty much forced the banks into having to invest in these low-yielding treasuries and mortgage-backed securities. And the banks are limited on what they can invest in. Okay, they're not out buying stocks.
Right.
Okay, so
we actually raised interest rates 9 times between 2016 and 2019. We were going to enter a recession at the end of 2019. Most of you guys may not have been trading or may not remember. But what ended up happening 3 months later was that we had an exogenous shock with COVID. Actually, I think that the Fed would have been hiking up to.
Sorry, guys. Wanted to interrupt for a second. I just pinned this to the top. Someone just shared this with me. First Republic is now publicly saying everything's okay. Everything's okay. Honestly, it's a little ominous. I'll let people read it. But the first tweet is, in light of recent industry events, we want to take a moment to reinforce the safety and stability of First Republic, reflected in the continued strength of our capital, liquidity, and operations. for people, and again, this is the goal here is not to introduce FUD. The goal here, the reason why I put that up there is actually if we can do anything in our little spot in the universe, maybe we can help First Republic not have a bank run. But this is, as many people will tell you, this is risk management coming out and saying, hey, we got to do something. They would have said nothing if they didn't have to. So, Aman?
Yeah, I mean, that was a similar message to what was said yesterday, wasn't it? Which is First Republic saying that the problem isn't there, that we have the diversity and this problem won't occur. And so the concern is that in trying to protect SVB, and the issue has been enlarged a lot more and actually causing the very thing that everybody's stopping. Now, my question to Dennis is, Dennis, you mentioned that, the US was able to send 100 billion to Ukraine. And so in terms of what the previous speaker said, Massey, that 20 billion more won't be an issue. But isn't that the problem? Like most people in America, and this is the other side of it, that most people in America are struggling because of those decisions, and therefore a further decision to spend more money on solving an issue that was made where mistakes were made is another burden on the American
Sulaiman,
people.
so a quick question. Sorry, to add on to the question and something, I just heard you say that. When you say the US sent X dollars to Ukraine, they didn't send that in cash. Isn't that just weapons they have sitting there? So it's just weapons, the US weapons that they're sending instead of just sending capital. Just something important to differentiate.
Okay, so couple things. Let's just think now. First of all money is fungible. Whether you're sitting in cash or you're sitting in arms, the arms cost the cash. So I'm not sure that that distinction counts. Second, $20 billion to make sure that the banking system feels better and that you cauterize the wound and you stop the panic is a gnat on an elephant's backside in terms of the cost to the economy or to taxpayers or to anybody. It's nothing. And this government can't scratch its elbow without spending $20 billion. They're spending $1 to $2 trillion more each year than they take in. So it's a matter of what you spend it on. And in this case, to tell depositors who put cash in one of the top 20 strongest banks in the US and said, okay, I'm going to be safe. They weren't speculating on, Bitcoin or Dogecoin. They were putting money into a strong bank, and then something happens. And yeah, the bank, those guys are going to pay a huge price. They've already paid it. My gosh, I can't believe how fast this happened. And that, guys, I'm wondering what you think. Does that make the system, the people in it, feel safer, or does it instead raise more fears because you say, God, you guys couldn't even wait until the market closed? It was that urgent? You moved right in the morning and just shut them? It makes you wonder, are you worried about systemic stuff you haven't told us about? I don't think
Well, they should be worried about systemic stuff. I don't think 20 billion is that big of a number. I think you're absolutely right. And I don't want to be political, but when talking about the situation in Ukraine, we spent $2.3 trillion outside just in direct dollars in the Afghan war, and including Pakistan. And there are estimates that the indirect costs were much, much higher, closer to $8 trillion.
Yeah.
There are 11 million registered army participants in Ukraine that are military. We essentially are paying a group of 11 million people to fight a war for us, because if we didn't support Ukraine, who is to say we wouldn't be in a bigger problem where Russia would be encroaching on the entire Eastern European bloc?
Yeah,
when it comes back to the banking system, $100 billion to Ukraine, we are essentially subsidizing the Ukraine's defense against Russia without actually sending one soldier over there. So you need to actually understand the geopolitical ramifications and the benefit to the U.S. economy.
No, in terms of geopolitical ramifications, we've discussed it.
I'd rather have them fight. I'd rather help them fight the Russians. I'm with you. Okay, I'm just saying that if we can afford that. I mean, long ago, Congress decided guns and butter. Remember, in economics, we could only have one or the other. Now it's both, right?
So Dennis, I mean, coming back to the point, the issue is this, and to be honest, we discussed this yesterday, and I got so many messages from Americans all feeling the same way. They were all basically saying, yes, why should we have to bail out the rich? And so we see people like, Meghan, Oprah, Harry, these type of people banking in SVB. On top of that as well, there's information come out that it was a very risk-taking bank in terms of a lot of the startups that went there went because they weren't able to get credit from larger banks. And also when they were getting credit, that was linked to them actually using the bank as debit. So all of this was that they were partaking in risk. So now, why should the average Joe who's already struggling have to basically help in that situation? The
Tim,
market
to answer your question, the
in a,
average Joe doesn't have to actually give any money into it. Like we said, you could set up an insurance fund that up front the government might seed, but the banks themselves will pay for it. I don't understand why everyone keeps going back to it. We are not going to pay for it. In TARP, all the money came back and the U.S. government actually made money from
Yes,
TARP.
you're right. But also, if I may
So
say, gentlemen, if I could get in here, this is about image, and by closing down the bank so suddenly, they no longer have a messaging department, a PR department, and if I were advising them on messaging, you'd say we are not bailing out Oprah and Meghan Markle. We are bailing out over 1,000 startup companies who employ over 100,000 people. We are bailing out the companies trying to invent the next apps that are going to make life better.
Don't say we're bailing them out.
No,
we're
bailing,
temporarily
right. We are
backstopping
We
them.
are
So
making sure that they can meet payroll.
I want to say one thing on this. So just to give kind of throw a bone to those on the side of let's just say making depositors whole, okay? And I understand that, okay, because it is not their fault, regardless of whether they should have, diversified where they held all their money. But if we have a Treasury Secretary Yellen that goes over to Ukraine and provides support for Ukraine pensioners and pensions, if we're going to do that, then we should be taking care of our own people and in the United States in a situation like that.
Good point, department.
Do that in Ukraine, okay?
And I'm not even saying that's right. I'm not even saying we should.
Sorry, Special. What about precedent? So now you're basically helping this bank out, because we don't want to use the word bail. You're helping the depositors in this bank out. So next, is this going to now because of bad decisions by the bank and some bad decisions by the people?
Well,
so is this going to happen all the time now? So is it every single bank going to be saved? No, but from now on, are you going to save every bank?
There is precedence for this. In 2010, I guess it was through an act of Congress that the FDIC did have 2 years of unlimited insurance for depositors.
Yeah, it's not completely unprecedented. It's happened.
And I think an even better answer may lie in the example of Lehman. The government said no because that's the second bank. Bear Stearns got in there. We can't bail out this one. And oh my gosh, the chaos that unfolded around the world because of that one little decision. And by the way, then we ended up doing the TARP thing that was like, I don't know, I could swear the original figure was $864 billion. And, in the aftermath, I was covering that. Nobody had moral hazard. No one was saying, hey, let's kite it up and do more risk. They were chastened. They had the hell beat out of them in public, in Congress, in their bonuses. They were whipped and beaten. And it took a while to get the animal spirits back. So especially this time when the depositors, they just put their money in a bank. And the bank didn't even risk it all that much. They just kind of did some accounting stuff that was bad that they wouldn't have had to do if the Fed hadn't, put them on a roller coaster ride.
So,
although it is their fault, yes.
Yeah. So
that was the end of the point I was going to make earlier, was that the Fed is the moral hazard, where their easy money policies that extend for way too long create this risk of bubbles and leveraging. But then on the flip side, they pretty much forced, these banks had no other choice than to be investing in low yielding treasuries and mortgage-backed securities, and then to get rug pulled in a period of 9 months and literally saddle all these banks with losses over, in less than a year it's the Federal Reserve that's creating the moral hazard.
I agree. And then to do everything they can to force this economy into recession, to jawbone it down, to inspire lack of confidence, and yet consumers don't get the memo. They continue to have a good time. They had pent up demand, and plus the government had handed them $2 trillion even to people who didn't need it in the COVID stuff, and so that was still in. It just had a lot more velocity than the previous 08 meltdown. That money stayed locked up and didn't move in, but this moved into the economy, and so it's defying the Fed. And now they're going to do whatever they can to drive this thing into recession.
And on this policy of restrictive policy, they are going to go. They're going to keep it restrictive for too long, and there will be more. We'll be on these spaces in another month or a week or 2 months discussing another, institution that collapsed for the same reason, because the Federal Reserve, on their policy, they stay restrictive for too long and easy for too long.
Yep.
So I just shared
It's
a
Danish. Danish, do you want to read the article?
yeah. So
From the
there's
Hill?
2 new articles that just came out within the last, just kind of talking about the sentiment in DC right now from both sides of the aisle, actually. And so I posted it up in the Nest, and I'm going to be posting. Just give me 1 second here. I'm going to post the other one up. There you go, up there. Both of those kind of going one side and the other. So I'm going to walk through this because and is a harbinger on what's going to happen as this comes inevitably. I mean, depending on where you stand on where how high the contagion risk is, I think we're starting to see at least the narrative start to develop. So I'll start with the one that I just posted, which is the GOP presidential candidates react to Silicon Valley Bank collapse. It's from Fox News, and 3 announced Republican 2024 presidential candidates weighed in. So first, President Trump's campaign blamed the anti-America policies from the Biden administration, and they kind of go into a little bit of history there, but this is the response to some of the more progressive lawmakers blaming Trump for signing a bipartisan bill in 2018 that rolled back elements of Dodd-Frank, and they fired back today saying out of control Democrats and the Biden administration have pathetically continued to try to blame President Trump for their failures and desperate lies, such as the CCP spy balloons, the train derailment in East Palestine, and now the collapse of SVB. The Trump campaign spokesman, Stephen Chung, told Fox News, this is nothing more than a sad attempt to gaslight the public to evade responsibility. The fact is that Biden has presided over a catastrophic economy that has devastated everyday Americans and has caused misery across the country due to his anti-America policies. Nikki Haley also jumped in and she said, taxpayers should absolutely not, here's the big words, bail out Silicon Valley Bank. Private investors can purchase the bank and its assets. It is not the responsibility of the American taxpayer to step in. The era of big government and corporate bailouts must end. Ramaswamy, we heard from him yesterday, and he again, Fox actually picked up Mario. They picked up some of the commentary from yesterday, not only his tweets but also in general what he said. But SVB should be allowed to fully fail, and that the FDIC should increase the guarantee level to prevent a run on the bank. So no bailout or help for depositors for deposits at SVB, according to Vivek Ramaswamy. And again, we had him on yesterday. That is very much in line with what he said. And it's very interesting to see that side of things. I wanted to contrast that before we start hearing from the panel. Wanted to contrast that to the other side of the aisle, who were all over corporate media today. And I'm going to pull that up. This is from The Hill. The title is actually kind of interesting. It said, "No appetite." So the lawmakers are in consensus on opposing potential Silicon Valley bailout. This bailout word is becoming very, it seems like it's coming out quite a lot from both sides of the aisle. So, they talked about what we've talked about, which is Janet Yellen ruling it out, repeating the words, "Let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and reforms have now been put in place, which means that we're not going to have to do it again." And then Bob Menendez of New Jersey said on Meet the Press that he's not ready to offer Silicon Valley Bank a bailout by any stretch of the imagination. We have to see he said, we have to see exactly everything that is pertinent to the specific set of circumstances and to see what else is out there, if anything else is out there that we should be thinking about. And then they go into, Nancy Mace from South Carolina sort of says the same thing. But the interesting one was former Speaker Nancy Pelosi from California reportedly said at a South by Southwest panel, and this is crazy because for anybody in the VC world or anybody in the investor founder world, we are going through South by Southwest right now, which is one of the biggest events. And all of these founders, with all of their money stuck, are sitting on panels talking about this. This is kind of, I hope people can get some of those videos up. It's a crazy thing going on in Austin for people that are not aware. And on a panel, Nancy Pelosi at South by Southwest said that she doesn't think there's any appetite in this country for bailing out a bank, and that she hopes instead for another bank to buy it. Fascinating. I think it's really interesting. The sentiment across the board is quite grim. Jay, what are your thoughts from hearing that?
Sure. So there are so many things to unpack there, and I've been multitasking at the same time. I will say that there's some breaking news that PNC and RBC are no longer interested in buying SIVB. They're two of many suitors that
Did they
were
give
looking at the bank. And and the second part of it, when you were ascribing, when you were quoting Fox News, which, by the way, the commentary and the lack of education from some of the speakers, bringing in social media personalities and musicians to talk about the Federal Reserve, I just caution a lot of what they're saying. I don't think it's Trump's fault, and I don't think it's Biden's fault that SIVB collapsed today. Just want to reiterate that it's the CEO Beckett's fault for not hedging rates. It's also not the Fed's fault, because they had to tighten the economy at some point. You can't have it both ways. You can't say, oh, the Fed kept interest rates so low for 15 years and then get mad at them when they actually raise rates. They could have easily hedged. And the second problem is with, Peter Thiel, that essentially forced the bank run. Now, I will say that if this was a systemically important bank and it was, category 2 bank versus a category 3 or 4, that they would have had to be part of the stress test. And I think whoever mentioned that earlier is 100% right. And I think for all along, I think what I've been saying this morning is several times that you could essentially set up an insurance fund where it's privately funded. You actually don't need a bailout, and depositors can get made whole through a new insurance vehicle where you actually don't need a bailout. It wouldn't cost anything when it comes to how big the U.S. banking system is to create that vehicle to backstop uninsured deposits. So I think we're all making this a really big deal. It is a big deal, but I think that there are very easy solutions to this. And in 2 or 3 weeks, I don't think this is going to be a major issue.
So special, but like for example, now we had Vivek on, and he made a very articulate, concise argument, and his argument was through obviously what his ideology is, which is capitalism, and he was saying in a truly capitalist society you have to let the free market decide, and essentially what you want is almost to beat China, you're trying to become communist. So I mean, his argument actually follows through with his philosophy or doctrine. So what would be your contention against him?
I'm sorry, could you repeat that? I didn't understand the question.
Okay, so Vivek made an argument that the bank should not get a bailout, nor should the deposit be recovered. And the reason for that is because as a true capitalist that he is, based on his own doctrine, you let the market decide. And that's what a capitalist society does, rather than governments coming in or whoever coming in to sort the problem out. So the issue is this, that his argument is that I'm a true capitalist, and hence why I'm following my doctrine. You are becoming when the situation allows, despite not liking communist China, essentially following communist ideals in certain situations and scenarios.
In many ways, the Chinese economy is not at all relatable to what we're talking about today. I will say that he's probably not a full capitalist, because if you were a full capitalist, you would give back all the money that you benefited from all the bailouts in 2008, and the fact that your S&P 500 portfolio has tripled over the last 15 years. Okay, you didn't want any of that money? Great. Give it to me. I'll take it. The U.S. economy is not a pure capitalist economy, just like we're not a pure democracy. We are a republic, and we are a hybrid capitalist society. If you think that after the Great Depression that we were a full capitalist society, you haven't looked at economic history. The entire reason to set up the Federal Reserve, the entire reason of setting up the FDIC, the entire reason for setting up healthcare the way that we have it, the entire reason why we subsidize government contracts for defense and are the strongest military in the world. There are certain parts of the economy that are utilities that need some support from the government. That doesn't even mean bailouts. It just means someone to organize all of the banks in order to put money into a new insurance fund. Just like I would have loved the government to essentially get all the VCs with 500 billion of dry powder and say, hey, assholes, you forced all your customers to bank with 3 banks, Comerica, SIVB, and PacWest, and you concentrated all the deposits in one area. It's your fault. And then you guys created the run on the bank. Why don't each of you contribute 1% of your dry powder, or $5 billion, which is not a lot? You guys are promising your investors 2 to 3x, which is 30% IRR a year. So you can take 1% of that money, put it into an emergency fund so that the public doesn't have to bail out these guys, and you can essentially backstop all the letters of credit from SIVB to the public.
So,
I want to take the mic just for Danish, if you don't mind. So we talked a few hours ago about a piece by the Washington Post regarding federal authorities considering safeguarding uninsured deposits at Silicon Valley Bank. And that was from anonymous sources. We got Jeff. Jeff, pleasure to have you. I'd love you to introduce yourself and give us your thoughts on where we're at right now and anything you want to add to the discussion. And then we'll have a few questions for you.
Hey, thanks so much for having me on. Obviously, it's been an incredibly fast-moving situation from Friday. Yeah, and thanks for shouting out my reporting. I really appreciate that. I had a story today with a couple of colleagues. We have about, I think, maybe 4 people now with direct knowledge of internal government talks who are saying that there is this conversation now going on between Fed, FDIC, and Treasury officials about can they, insure, essentially retroactively insure the uninsured deposits. Obviously, this would be a massive, massive step, fuel a political firestorm. I think it's pretty clear from everyone we've talked to that the hope remains, both among Democrats on the Hill and people in the administration, that a buyer will come and at the very least mitigate the urgency or need to do, to take a step like that. The other thing I should mention here is I want to stress as much as possible that we don't believe a decision has been made to go down this route. And also that even if this is a route that, let's say, the senior political and economic leadership in the Biden administration does think they need to pursue, it would likely require approval of 2/3 of the FDIC board. There are 2 of 5 members are Republicans who, this is speculation, but it's unclear, at least at a minimum, whether they would be open to this kind of extraordinary expansion of government authority. I think it's worth keeping in mind, obviously, that even if the relative number of uninsured deposits that need to be made whole or would be made whole by potential federal action is not that massive at SVB alone, it would set the precedent that in similar future circumstances, the government's either FDIC fund or other Treasury backstop monies are responsible for assuring uninsured deposits, which would, I think, don't quote me on this, but something like double the existing insured deposits pool. So I've blabbed on for long enough. And
well, Jeff, I wanted to start with taking us back a little. I saw your tweet about 5 years ago. You had the story on that regulation that now, for some reason, Jeff, everybody's talking about, right? Which is the rolling back of Dodd-Frank. At that time, you had interviewed Senator Bernie Sanders, and he was livid. I mean, I can read what he said in your tweet, but in your original article. But, at that time, there were some people that were crying foul. Do you think that has played a big role in what happened to SVB? I know we've heard all these different reasons why this happened, but do you think that the rolling back of parts of Dodd-Frank led us here?
I will say that it is too soon for me to feel like I can confidently make a judgment of that. I just don't know enough about exactly what transpired. What I do know is that there's a lot of smoke there that reporters should be digging into. I think it's pretty well established at this point that SVB was clearly pushing for this deregulation, and moreover that they fall right in the category of the bank that was deregulated in part by that bill, and also that federal officials were extremely late to catch the really tremendous amount of volatility at that bank last week, and questions about why they were not alerted to the fact that their treasury bets were going bust, and really imperiling the sort of financial stability of the bank. So again, I have heard from a number of experts that I really trust that are saying this is a proof, not just Bernie Sanders and his allies, but people who are more in the center of the political spectrum, if you will, on these kinds of issues. But
Jeff?
It's certainly worth evaluating.
Yeah, if it's Dennis Neal, guys, if I could just step in, I so hope that Washington can avoid politicizing this current crisis and instead work on a solution, right? Because let's remember that Silicon Valley Bank put money into government securities, government treasuries. Okay, that wasn't something that was allowed by deregulation that never existed before. So the deregulation fight has nothing to do with it. If you want, look at the regulation that came in after the 2008 meltdown, where they said you have to put it into safe government security. So it's not about that. They just put it into the wrong place. But Jeff, you said something. I needed to make sure that I have this wrong. Did you say that the talks for ensuring a larger portion of the cash deposits, larger than the usual limit, did you say the talks are only to double it from 250,000 to 500,000? That would be, or
No,
did I just not hear that?
I don't know where you heard that.
Good. Okay, thank goodness.
What I was trying to say.
You said something about double.
Hold on, this is an important point to clarify. What I was saying is that my understanding is if this was to go through, and let's say that we establish the precedent that the FDIC picks up all deposits, bank deposits that are currently uninsured, it would amount to effectively a doubling of the existing pool of insurance deposits that the FDIC is responsible for.
Nationwide. It would
nationwide,
just for that one bank double that sum. I see. Okay.
Yeah, and so
thank you so much.
Talking about this, and kind of walking through the timeline of it. We went all the way back. Now we're going to come a little bit fast forward. There's been a bunch of information that has come out around the actions, what led to this crisis. We talked a lot about this yesterday with the Moody's, the downgrade warning, that downgrade warning then leading to a scramble, the scramble then leading to action and meetings, those meetings falling through, FDIC coming in, taking over. And after FDIC came in and took over, all of this work starts. In your reporting, there was a very interesting, or in the reporting from Washington Post, there was a very interesting quote that you highlighted, which was that the Democrats said that they were praying for a buyer. This was Brad Sherman of California, member of the House Financial Services Committee. And then my favorite line: big buyer, small buyer, fat buyer, skinny buyer. We need a buyer. That's one of my favorite
all
lines.
All buyers
ever.
to the dance floor. Yeah,
that's right. What happened? Why has Jay just special situations? Jay just mentioned that PNC and RBC are both off the table reportedly. So why have they struggled to get a buyer from your reporting?
Man, that's such a good question. I don't really have much more beyond sort of people outside that process, unfortunately, and I don't want to speculate too much. My impression.
It comes down to merger accounting rules, but go ahead.
No, go ahead.
So when you have a merger, you have to fair value the assets. And one of the biggest issues when you have a merger with a firm that has a $15 billion plus hole, in my opinion, probably closer to 20 to 25 billion, given the duration of the MBS, that you actually have to mark to market those bonds before the acquiring company can take them over. So the acquiring company is now responsible for that loss, is responsible for the unsecured bonds, is responsible for tens of millions of preferred shares to cover them. And at the very end, probably has to give a hat tip to the equity in order to take over this business. And even if they don't, I just think that the check that these banks have to write is much larger than the market cap of the company at the close and pre-market on Friday. So the actual check is a lot higher than people think it is. And I think that's one of the reasons why, PNC and RBC might be backing away.
And so, as this happens, Jeff, what is the sentiment, from your discussions? It seems like the sentiment is cautiously optimistic. I don't know if that's how you would describe it. What is the sentiment about a potential buyer or what they will do instead? I mean, you quote tweeted Sam Altman saying that the FDIC is currently reviewing the, just covering everyone's deposit. Yeah. Is that realistic, really?
Yeah, I mean, no, I wouldn't have written that tweet or that story if I didn't have really solid information that is a live thing they're looking at. Again, I think there's still hope that we get to Monday and this is, with the Bank of America and it's all over. But I wanted to go back to that Sherman quote because I think it speaks to the impossible situation that congressional Democrats, particularly California Democrats, find themselves in, where they're simultaneously feeling immense political pressure to prevent the contagion from spreading, from layoffs from hitting the firms that were dependent on payroll processing at this bank and sort of the economic fallout. But they are equally, maybe not equally, but they are also really skittish about, touching anything within 30 miles of the word bailout. And so the only solution that gets them out of either option is a buyer. And you see that desperation in that quote. And, they will run up and down screaming as much as possible that if you say that the thing is not a bailout, then it's not a bailout. But I think, our job is to not, if there is special federal assistance, financial assistance to a private company beyond what the law, previously stated, it is hard to avoid the conclusion that it might in fact be a bailout.
And you're talking about the optics of this. What about the optics of the fact that it's called Silicon Valley Bank? If it was called, I've made this joke a couple of times, but if it was called Farmers Unions Bank, perhaps it would be a very different situation. Are the Republican side of the aisle struggling with that in terms of, different options that could be on the table?
Yeah, I was talking to a Republican who was like kind of sort of marveling at the political challenge here. And he was like, the only thing worse is if they literally called it First Woke Bank of America. I think that is super reasonable. But I also think a lot of Republicans would have an objection to this for other reasons. They don't want to invite the regulation that would ensue from any special federal assistance, right? Like the FDIC, when it was first created, was opposed by Republicans, not because they didn't believe in, financial support for the banking system, but because of the strings that come attached with it. So,
if I may add to that, Jeff.
Yeah, please.
This is Dennis, guys. A far smarter person than I has pointed out to me that if you remember, after the big TARP bailout and all of that stuff in 08, 09, here Jamie Dimon and JP Morgan Chase and other banks, they stepped up. They rescued failing banks and helped cauterize the bleeding and stepped up. And what did they get for that? They get called before Congress and railed by, Elizabeth Warren and the Senate and you bad guys. And now look, already, as Jeff has pointed out, people are saying, we're not going to bail them out. And these are rich people. Never mind that it's 1,000 startups, vibrant startups who want to meet payroll. And I just think that's unfortunate that it's shaping up that way, because maybe the banks are afraid to step up because we don't want to be held up for ridicule for taking over this bank like we were last time.
It's much simpler than that, Dennis. The Republicans don't support the bailout because they know there will be a strong market reaction if there is no bailout. So they can shit on the Democrats for having caused that. What I think is happening here, the US government realizes how important it is to restore confidence immediately to prevent a market crash on Monday. And the first Yellen statement was so wishy-washy that, I tweeted and said this is going to cause a crash on Monday. And now you see news following up this first interview, now suggesting there may be a full bailout of deposits. And if they are not doing that, they will have a bloodbath in the markets on Monday. So I think there's a really strong indication now that they will step in and fix this.
Yeah, what is the thought, Jeff, on the contagion risk that exists of, this initial bank run leading to multiple other bank runs?
Yeah, I'm not saying anything you guys haven't heard before, but I think the government officials I talked to are quite concerned that the similarly situated banks will see customers fleeing for the GSIBs as soon as Monday, and are hearing reports of that. And I don't think anyone thinks that we're on the precipice of 2008, but the potential for these dominoes to fall, and for something that seems contained to first spread to 3 or 4 other banks. I don't know if there was a chart going around that showed the number of banks that had seen their stocks collapse by 15-20% at the end of last week. Though there are, a handful of banks that seem kind of obviously like the next vulnerable targets here. And if those are really shaky Monday and they don't have a buyer, it's a pretty fucking scary situation, I think. I've never, my first time as a journalist covering this, but it doesn't seem like a fun environment.
It's really
it's nowhere near as scary as 2008 was, by the way. I couldn't sleep.
I agree.
I couldn't sleep at night in 2008.
Yeah,
Right.
08, 09, when I was on CNBC covering it, that was the first time in my entire career of 20 years or more covering business that I was truly afraid. And yet we came out of that. We came out great. And the other contrast here is, let's remember.
Do you remember their $200 ATM limits in 2008? People aren't talking about how bad it was.
I mean, we had exotic dancers who were granted mortgages to buy 10 homes. Okay, we had speculation going like crazy. We had CDOs. This time around, it's because the big banks have run up. It's $162 billion in unrealized losses in their government securities that they were pushed into buying as higher quality reserves after the last meltdown, and now they're getting bit in the ass by it, and yet it's not the super high yielding crazy stuff.
Can I ask? I mean, I'm curious to what extent you guys think the fears of contagion are self-motivated by people who have a direct interest in preventing the deposits.
Everyone has a bias in this. There are people who are long equities. There are people who are short the banks as of Thursday and Friday. There are government officials that want to grandstand if the market falls. There are government officials that want to applaud if this is solved. So when anyone speaks, including me, we all have a bias. Is the first thing that everyone should know on this space, and evaluate everyone's biases as they're speaking.
Well said. Hey, Mario.
Except for us, we have no biases ever in anything.
Yeah, exactly. Not the
No, I have biases. I love America. I'm a citizen.
You guys act like this is the only group that took out a bunch of 10-year treasuries that have unrealized losses.
No, it's 600 billion of AFS and HTM across the banks, but it's mostly the very large banks.
What about the $20 trillion of commercial real estate that's been purchased in the last
The 21 trillion of commercial real estate, 40% of which is office and malls, isn't a big issue. And we actually talked about shorting the CMBX triple B and how Icon is short the CMBX triple B 6 series. So, there's a lot of coverage on the real estate situation, but that's going to unfold over the next 3 years. That's not going to unfold tomorrow.
And Jeff,
but I'm just talking about the fear of fear.
Grant, your audio is a little muffled, just so you know.
Yeah, I've actually got to run back to reporting. So thank you guys so much for having me.
Enjoy, Jeff.
Thank you. Really appreciate it.
Really great job.
Appreciate it, guys. Have a good one.
Thanks. Grant and Wahid, you guys, I think, were speaking. Yeah, go ahead.
Grant, your audio is a little muffled.
Is that better?
Yeah, much better.
Yeah, sorry about that. So, 2008. I mean, we haven't. This thing hadn't completely unfolded yet either. So to compare this to the fear of that Monday is probably not fair. And this could be the first signs of what we all know from both sides, left and right, from Kim to people more conservative with have more hope in the U.S. economy. You guys all know we have problems. and they're not getting better. I don't know
Everyone
where
has
they go.
problems. Everyone has problems. We've always had
I
problems.
agree with that. And I agree
The
with
media
that.
has made the problems a lot worse than they seem. And across the world, I will tell you that the problems in China and Russia and Saudi are a lot worse than the problems we have in the United States today. I can guarantee that.
Right, and I believe that, but you know, I just know that at least from my commercial real estate experience, there's a lot of debt out there that people are having to confront today, where 80% of their portfolios, huge exposures to adjustable money, that if that money doesn't get cheaper, it will not be able to be recapitalized at the values they have it on their books for.
Well, the
And
one
That is 100% correct.
but the balancing point of that, if you'll forgive me, is that there aren't there hundreds of middle range, mediocre, not great companies that were able to refinance debt at zero interest rates, and they've been walking dead and not really growing, and they're out there and not going anywhere, and yet they were kept alive by zero interest rates. And now that rates are going to 5% or 5.5%, maybe that separates the good ones
That's
from
true.
the
But
ones.
during COVID, the high yield maturity wall of the triple B minus and Baa3 companies was pushed to 2025. But with real estate, none of the banks were willing to push out their maturities. So commercial real estate is a bigger risk than zombie companies, although we can have an entire space on zombie companies. I have a list of over 180 of them.
Okay, you clearly know so much more than I do, so I'll just ask a question though. Last time around, I remember we saw the big housing crash, and we worried on CNBC like crazy that the next thing to crash is going to be commercial. And you know what? It held up pretty well, didn't it?
It held up because a lot of the banks were able to push those maturities out. But the commercial real estate crisis is much bigger. There are still companies from 2007, 2008 that should have gone bankrupt in commercial real estate, but because banks didn't want to take those losses, they pushed those losses forward. I don't think they have the opportunity to continue to do that. And there's several $100 billion of, like you said, of commercial real estate maturities. And we actually saw very big asset managers that didn't need to do it, but Brookfield, PIMCO, Blackstone, and Starwood in the last 3 weeks all walked away, essentially filed bankruptcy on debt and defaulted on debt, first lien debt at banks from large office towers in San Francisco, in downtown LA, and in New York City.
Understandable though, right? Given the whole Zoom revolution and the
I wanted to hear from some new voices who have been joined and had their
Okay,
hands
thanks
up
so
for
much,
a long
guys.
time. Thanks, guys. Bob, thank you for joining us. Did you want to weigh in on what's been discussed?
I did. Thank you so much. I been listening for a couple of days, and I have a little bit different perspective. I have a very good friend of mine, Dr.
Bob, can you fix your mic? Maybe get it close to your mouth.
Yeah, let me just get off these earbuds. I think that's the issue. Hang on one second.
Perfect. Thanks a lot, Bob. I
Yeah,
appreciate
while
it.
you're
In the
doing
meantime,
that,
Wahid would love to get your thoughts on this.
Look, I apologize. I got off a flight. Did you guys talk about the Fed window already?
we have in what sense?
That
Sorry.
we'll probably get an announcement that they're going to ease conditions and, just put out a statement, even though the Fed window has technically always been available, to try and encourage.
We have not talked.
Okay.
Love to. Could you kind of do a deep
So
thinking about tomorrow?
So Bloomberg just broke the story, right? They're going to put out an announcement to ease conditions for banks to get to the Fed window, right? That's basically they go and they use the swap lines there and they post the collateral, and it doesn't technically. There's a lot of leeway that you don't have to market it the way you have to liquidate securities in order to shore up your balance sheet. Here you could just post the collateral and then use the swap lines to tap the discount window.
Wahid, could you share that with Mario and the team just so that we can post it
Yeah,
out
I think
there?
it's just on Bloomberg, right? So I apologize. I don't know. I'm really bad with technology, so
Hey,
I don't know how to do that. Mario, can you do it?
Hey, I can speak now.
It's a headline from Zero Hedge.
What's
but
that?
I'll look for it.
Bob,
Yep.
1 second. It sounds like there's some new news on the Fed.
Yeah.
So just give us 1 second. Did you have something to add on
So
that?
but the only thing I'd say is that is significant. There's no bloody way they're going to do that and panic and raise rates as aggressively as some had feared in the last week. Maybe they squeak in at 25. I wouldn't be surprised if they just halt. All that will be synchronized. So I think, unfortunately, you want to stop panicking when the regulators panic. That's the saying.
and we're seeing a lot of people panicking now, right? Fed, FDIC, Janet Yellen. I don't want to say that's a good news, but it's reassuring that they're panicking early this time.
Okay, we're just looking through
Yeah,
the
so
article.
I've got the
And again,
story.
they only
Yeah, I've got the story. Let me read it out quickly before you go speak about it, Jay. So Danish, I've sent you through the link if you want to
Yes,
post
yes,
it in the above for everyone. Fed discusses easing access to discount window to help banks. Such a move would help banks meet any demands for withdrawals. Some banks already tapped discount window after Silicon Valley Bank collapse. So yeah, it
So
seems
Yeah,
that
this is a
they're
Hey,
stepping in to
this
Mario.
is a big
support.
signaling deal. It's not so tangible, but there's always a fear of looking bad when you actually approach that window. But it's something, and people don't have to actually cower to sell their securities for sale. They can just post that collateral temporarily, and especially if they ease the conditions.
huh.
Yeah, actually, Silicon Valley Bank had 55 billion of securities pledged to the Fed discount window. If they ease the conditions there and lower the cost of doing so, they could provide a lot of capital to banks that
Yeah.
have securities, and they could pledge them through the discount window.
Can someone walk through the details of the discount window? I think the average person, we've got something like 16,500 people in the room. I bet you
Yeah,
90%
Wahid would be
of them don't know.
great at this.
Yeah, Wahid, can you walk us through how banks actively use? And Bob, just give us a second. Sorry, with his breaking news.
I know,
we want
but
to
I
address
have
it
all the
directly.
answers you guys are trying to get. I've been trying to do it for 2 hours. I told you guys about the discount hour
Sure.
2 hours ago. Okay, go ahead.
All right, Bob. Go ahead, Bob. Can you describe the
Yeah,
discount window
so
for us and
listen,
how these banks could
I'm
use
a
it?
43-year veteran in the markets. I was an institutional trader in 1980s when Volcker was raising rates like this, and everybody's talking about this never happened before. I'm laughing. Dr. Jim Baker and I, we had a conversation. I can't mention names that were on this call, but going back to Penn Square Bank and that failure, Jim was head of the American Banking Association, ex-professor. He's the father of asset liability management. If you look that up, it all is about exactly what's happened. He actually wrote an article 4 months ago about this exact event that's happening today. So let's talk about the discount window. The discount window is exactly what Volcker did. They did it bank by bank basis, and all this talk of bailouts and all this stuff is just ridiculous because this should SVB should have never failed. This was a panic by probably some amateur folks on the regulator side in California. FDIC came in. I think there's a conflict of interest that's very clear because Greg Becker was a director of the San Francisco Fed, for God's sake. So I think what happened is they panicked, they got caught, and they didn't do the right things. All they had to do was when all the VCs and Theo and all these guys pulled their money out, all they had to do is call the Fed up and say, hey, we have a liquidity issue. Can we go to the discount window and just fill this gap? We've got plenty of assets. We got good quality assets on the books. And the Fed should have said, hey, no problem. How much you need? 1.7 billion, whatever the number. And it was done. And this should be the case going forward. And this is just what the Fed said. And I've been dying to get on here. Thank you so much for finally getting me up here. But for hours, I've been tweeting and telling everybody this is the solution. And this takes away the moral hazard. This takes away the entire conversation for 20 hours that's been going on in this stream about all this speculation and stuff. So I think this is probably what's going to happen. There'll probably be, since they've already taken the regulatory steps toward closing the bank and everything they've done, they are now stuck doing some of these other things. But I'm sure that we'll hear soon that there's somebody has stepped up to take on these assets. Some bank, whether it's JP or whoever steps up, it really isn't going to matter. But I think this discount window, this takes away all this contagion issue, and you do it bank by bank by bank. And let's face it, this whole deal at SVB is a joke. It's a tiny little problem that came up that if it would have been handled right, we wouldn't be, I've spent my whole weekend trying to figure out what's going on. I would tell you, we manage about $15 billion in equities, and I, I, I'm going to be live on my own channel here in a few hours, and I've got to have answers for our institutional clients and other people as well. So as somebody said, we're all talking our book. We are all talking our book, but the information, I've heard a lot of talk about '08 and '09, but nobody's going back. And this is one of the things I've been talking about for a while, is that too many people are narrow focused on what their experience is. And Jim Baker always says, he goes, I've been around so damn long, I get to say what I say because I was there. And I was there as well. I was in a treasury bond pit in 1979. And, it was crazy times with what Volcker was doing. So we have seen something really substantial, even to the point where Volcker raised rates so fast that the money market funds were trading under par. And that really panicked people. I remember seeing lines in front of banks, people getting money out back in the old school days when you'd go get a check and actually get money. But just as far as a discount,
Yeah.
real quick, and I'll finish. I know I'm babbling on here.
No,
But
it's okay.
I want to bring in a little bit different perspective, because there's a lot of solutions other than what's been talked about for 2 days. There's so many, and they're very easy. And it's interesting that Jim and I were talking earlier. We had a little consortium of folks, and I would tell you that we all figured this out. This is all they have to do. And it's a very simple fix, and all this stuff goes away. And I always have a feeling, I'm sort of a contrarian, but when things get so loud that it seems so obvious and all this stuff we talked about, then the opposite, something different has to happen. And so it'd be interesting to see how the futures open here in 30 minutes and see what kind of other announcement. But that's all they probably had to do. I wouldn't be surprised if there's a bid in the S&P futures when they open and everything that comes on. But I really want, as far as the discount window, it is the solution.
Well, there's a spread bet.
Yeah, go ahead.
No, I was just saying the futures are up. There's a spread bettors in the UK that do a weekend market, and they're up sharply. And the currency markets, it's a risk-on profile right now.
Perfect.
The
So
dollar is weakening.
Wahid, one question I had for you is,
Yeah.
By
as
the
it
way, did
applies
anyone
to,
explain how the discount window actually
Yeah,
works?
let
that's
me
what I'm
do
trying
that
to say.
real
That's
quick.
literally what I'm trying to
Yeah,
get to.
let me
that's
do
good.
that very quick. So
Thank you,
basically, the New York Fed. Okay, I'm going to keep this very simple, but the discount window is a feature of the New York Fed, where any financial institutions regulated, right, can basically post collateral. And there's 3 different ways to do this, 3 different kinds of loans. I'm not going to get into that detail, but they're generally short term. Okay. And you go and you post your collateral, and then you basically get a line of credit. Now, by easing, you get to do probably a lot more and a lot easier, because there is something that says you got to be a sound bank, right? So by easing, there's probably the 14 banks that Janet Yellen is quote unquote worried about. They will be invited to go to the discount window and post a lot more collateral than they usually would for a lot longer and get a credit line. I will say that the discount window has always been available, but you probably could not have posted enough collateral to do another 45 billion of deposit outflows.
Well, also the cost of capital is going to fall, right? That's the biggest thing, right? These banks all have NIM. So if you're able to put $100 billion in the discount window and pay a lot less than you were able to pay last week, it's going to incentivize a lot of these banks to do that.
Jay, do you agree with
I mean, there is a stigma, but now by them going public and saying, encouraging banks to do that, that will relief. But I don't think it's everything. So I disagree with Bob. I think it's a very important move, but you do need to stop the run on savings and loans banks. And so some form of FDIC blanket, even if it's temporary, is very, very
And
essential.
I actually agree with you.
why they would need
I agree with you.
Wanted to add one thing, and Bob, I had a question for you. And yes, to add to the discount window, the banks that do go use that facility, it is made public. I don't know how quickly it is, but my question to you, Bob, I have a lot of experience too, not quite as much as you, obviously, but when the Fed announces a move like this, like easing the conditions to which banks can go to the discount window and borrow and maybe post different kinds of collateral, is that sort of a window into how they're going to act at the next meeting, like maybe not raising rates or maybe just a quarter point? What are your thoughts on that?
My thoughts on that are sort of mixed, because I feel like if some of the things that were discussed earlier, if the Fed came in and said, hey, we're pausing everything, no more QT, we're not going to raise rates. In fact, let's drop them a quarter point, I think the equity markets would plummet. All that would do is emphasize how screwed up everything is, right? So by what they're doing, I think I think they still do a quarter of a point. I've got a terminal rate target about 550 on the Fed funds. And as far as I'm concerned, I think they still go there as long as they, and you're right, I forget who it was who was talking about the FDIC. Now that they've made this move, the FDIC absolutely has to be part of this, and the regulatory entities are there. But I think this could have been avoided initially on a simple phone call. The only thing I could figure out, there was somebody panicked in San Francisco Fed that there was some kind of conflict. That's speculation, and that's tinfoil hat a little bit. But the bottom line is something there that this should have been really easy to do that. And even if they did a one-off, like, hey, we need to make an exemption, just like what they just did for this bank, none of us would have spent our whole weekend doing what we've been doing. I had a whole different weekend planned, right? We've got a lot of money at risk and a lot of things. So as many of us on this call, we have to do what we do. But I don't think that they change much. I have been very hard coded here as far as the Fed's going to continue to fight their inflation. And if they can stay on that track, I believe they do. If they pause, if they don't do a 25, I think the messaging could be kind of interesting. So we got a long ways between here and the 21st, right? So it's a long run, a long runway.
We'll probably get a leak from Nick over the Wall Street Journal tomorrow, because there are in the blackout. I do want to say something that's not tinfoil at all. There is a reality. Janet Yellen was the San Francisco Fed, and the person who runs the New York Fed, John Williams, came from San Francisco as well, from that central bank. And I don't think it's crazy to believe that a lot of the banks there are making phone calls to people they know really well.
They have Beckett's direct line. They're talking to him in real time.
I'm sure of it.
Yeah. So they know this,
absolutely.
right? So there is a leaning tilt that is friendly, right? It's not as hawkish as you would have otherwise think. That, I mean, the two people that matter a lot are from the San Francisco Fed.
Absolutely.
So I wanted to invite introduce Mark Cohodes. Thank you for joining us. Wanted to make sure that we let you weigh in on, obviously the whole world has changed in the last hour with this discount window thing. And again, it's starting to become obvious that the Fed is going to take significant action to prevent bank runs. Do you think that they're doing enough? Are they doing too little? Doing too much? What are your thoughts about
and Danish, just to add to that, like Mark came on yesterday and it was quite surreal because at the beginning of the stream or the space, everyone had one position of view, and when Mark came on, the entire space changed. So I think Mark's got an alternative view to everybody else, so it'd be good to hear.
Yeah, Mark, would be very interesting hearing.
So, I was just riding horses. So I still think someone buys Silicon Valley Bank for very little. I said that last night. I continue to believe that right now. This discount window, I mean, I think the Fed and the FDIC are just a complete mess. They created this mess. So this is sort of more of a mess. Short term, fine, you can hit the discount window, the sickest banks. But the caveat to that someone's not bringing up is the Fed's going to force these sick banks to raise equity, to raise, the money that they're in the hole on. So you may be able to hit the discount window, but they're going to dilute the living crap out of their shareholders. And that's part of the dirty little secret that people don't know or have yet to kind of factor in this thing. So
I don't know. I mean, I think this entire situation is a mess. I think it's been a shit show at every turn. I think this SIVB could have been prevented in the way that it was. I think the government and Thiel and all his Silicon Valley pals created this mess. And now the government, in true government fashion, tries to clean it up. But you just create more and more zombies. So they're just sort of kicking the can down the road. I would have rather seen something different to sort of isolate these zombie banks and have less of them and let the good guys prosper. But we'll see what happens. I think the holes in a lot of these banks are going to have to get filled through raising equity. And I think hitting the discount window, in the short term it may keep banks from having bank runs, but it's not bullish for the bank. It's not bullish for the equities of these banks. I think the strong will do better. I think the weak are going to suffer.
But doesn't the strong here represent the biggest? I mean, isn't that kind of what would automatically happen? I put myself in the situation of somebody that's working with a small community bank. If I'm constantly thinking about going to the strongest bank with, and especially with a rational fear, it is a rational fear that could be a bank run. Wouldn't that automatically just consolidate all the power in the biggest banks?
Yeah, on some ways, yes. But the bulk of the people, either on this Spaces call or in society, 250,000, have 250,000 in a bank. So this is really addressing the upper 1% of the 1%. I mean, most people.
Well, you're assuming individuals here. What about businesses?
Well, if you're a business, kind of worth a crap, you should be banking at Chase, JP, Wells Fargo, Citi, U.S. Bank Corp, PN. There's a ton of banks here. I mean, I can't stand Canada. I mean, it's Arctic Mexico, and the place is the eastern branch of the CCP. But there, at least, they only have 5 banks. So the government, de facto controls 5 banks. Here, you have more banks than you have restaurants in this country. And the question is, when banks get as out of control as Silicon Valley Bank, these accidents happen. And they do it because they had a stock and everyone wants to get rich and no one cares about risk and everyone wants to live for today.
So, Mark, I'm just gonna jump in very, very briefly. So PNC Financial Group has decided against bidding on Silicon Valley Bank as regulators struggle. So PNC is not gonna be bidding on Silicon Valley Bank. CNBC just
Hey
reported.
guys,
Okay, well,
And markets just dipped on that. I mean, they didn't go negative, but they lost a little of their.
can I just say one thing, and I have to leave after this, so to be very quick. I went through all the constituent list. I am a quant primarily, and I went through roughly 265 stocks, primarily in KRE, which is the Regional Bank Index, and QABA, which is a First Trust. And I did this analysis for them, and about 60%, this is interesting, we'll see if it comes out, but about 60% of the stocks I looked at, that every one of them at least looked like they were going to rebound from what they did on Friday. So all of this stuff was being driven down, the hedgies and everybody the algos were all over the banks. We all know that, selling. But it looked to me that a lot of these things were pointing out. And when we had our little private discussion several hours ago, one of the things that I brought up is that not all banks are bad because SVB went down. There are tons of really good banks. And matter of fact, some of the signals and things that we look at from our quant stuff, if you looked at them on Wednesday, you went, shit, this is a pretty damn good stock. I need to own this. Matter of fact, if I already own it, I should buy some more. And then Friday happened and it looks like a piece of shit. And then the reality is nothing fundamentally probably changed with a lot of these stocks. And these are the QABA and the KRE. Both are, there's a little overlap in those two indexes,
But all of those are, community banks. The QABA is the Community Bank Index, and I think there was a total of 165 symbols in that. But I went painstakingly and researched every one of these damn things, trying to figure out if there was something there. And then Baker was out. He's the fundamental guy, balance sheet guy, because he's the asset liability management guy. And he has an article he's about to release on Seeking Alpha that's called the autopsy of Silicon Valley Bank, and he's going right through everything. So you might want to check that out. And he also wrote that article back. I called when Baker and I talked back in October. We had figured out that this depreciation in these bond portfolios were going to screw over every bank out there. So everybody, this is a systemic issue. I want to put that out there, but it can be controlled possibly through this discount window. And that was, I think, I'm not because we came up with this earlier, I think it was a good idea, but I think it was the only idea that the Fed could do and actually keep some credibility without getting into this damn moral hazard. I know we had, I forget the senator was on earlier. Nobody wants to touch this damn thing because of 2008. And so I just want to put that out there that I did go through these banks, and there are a bunch of them I fully expect will rebound. And if the pre-market, we're going to have the open here in about 15 minutes on our futures. We'll see how they open up. But I just wanted to put that out there for you guys. And I'm going to have to take off because in about 2 hours,
Thanks,
I got to
Bob.
be live. So
Appreciate
have
it.
a great rest of your space. I really appreciate you letting me up.
Yeah. Thanks, Bob. Appreciate you jumping on. Mark, on that note, on systemic issues and system level issues, are you concerned at all about the contagion effect? I mean, it sounds like you think it might be good to prune, or you're not worried about the contagion effect and how it could affect the entire system?
No, I'm not worried about contagion at all. I mean, there was William Cohn, my pal, he just tweeted something. It makes a lot of sense. He said, this is from Dennis Kelleher. He emailed me some serious wisdom late Friday night. He says, to me, the fundamental problem is that the Fed is trying to fix problems mostly of their own making while not admitting they had any role, never mind a decisive role, in creating those problems in the first place, which causes more problems that they have to fix, he wrote. Sooner or later, that leads to catastrophe. That's my point. If anyone on this call, near or far, believes in free markets, this isn't a good thing. Now, contagion, like the only people who really complain about contagion are these fake VCs or people who made money on zero rates, who bragged how smart they were when they made, and now that things are a little choppy, are just begging for a bailout. It's just, look, it's just wrong-headed. The government's going to do what they're going to do. They don't give a rat's ass what I think, and it is what it is. But let the zombies go, ring fence certain aspects of it, and let the strong do what the strong do. And if there's less banks or less restaurants or less department stores or less taxi apps, it's not the end of the world. The problem is spending money to defend people who shouldn't be in business in the first place.
Mark,
they don't bail out hedge funds, I'll tell you that. And they
but
don't bail out.
in this situation, sorry,
Yeah.
just to kind of play the other side. In this situation, people, small businesses, similar to the ones that you've run, small businesses put their money in a bank. It was the 12th largest bank that was very connected to the community, and that bank, put their money in government securities that were very. It wasn't like they put them in risky assets specifically for that. For what caused this? What caused this was the long duration of those securities, and they did that. Interest rates went up. Why should those businesses and the employees of those businesses, pay for if you're a small business and you work with a local bank, and especially a bank that, by the way, my company went through Techstars, other people go through YC. These are people that are connected to these really well-established ecosystems. Why should those companies be the ones that pay here? It's not about merit. It's not about survival of the fittest. This is a 12th largest bank in America. We're not talking about, a tiny little bank in Minnesota. No offense to Minnesota, but we're talking about the 12th largest bank in America. Should they really be paying for this, error?
So the bank itself is going to fail, right? The bank's failed. Now someone may buy them, and the small business can thrive or keep going. Great. My point last night, my point today is VC funds and private equity funds have trillions of dollars of dry powder. To your thought and in your spirit, any one of these swinging dicks can easily come in, create a new bank, bail out this bank, and help the small business. And I'm all for small business. I'm all for entrepreneurship. I'm all for doing things the right way. What I'm not for is bailing out asshats who screwed this whole thing up to begin with. And at a minimum, if you tap the window on this emergency credit or whatever they're putting out, you should also replace management, and you should also replace the board, because your decisions put your bank in these bad straits. No one tells these guys to invest long with rates low. No one told Austria to issue a 100-year bond. I mean, people do things. Some make good decisions, some make stupid decisions. But again, everyone on this call, no one's getting bailed out if you make a mistake. No one. The only ones who get bailed out, and it's usually the people who benefited from these fast and loose rates and cheap money, are all screaming poor today. And it's just hypocritical as hell that this goes on. It's wrong-headed. It's wrong policy. There's always going to be
Mark, but I don't believe in someone else's. Again, when you think about entrepreneurs, the last thing, Mark Cuban said this yesterday, the last thing that they're thinking, they were accounting into their risk, was a bank run. It was not even in the top 100. There's so many ways for a startup to fail. Bank run is not top of mind, but I understand your point of view, and I think it's about how closely do you stick to free market principles. Sometimes these types of events happen, and it's not nice and it's not pretty. But moving forward, what do you think the Fed should actually do? Obviously, sounds like you're in favor of the discount window. It sounds like. What else should they actually do? Should they let it all burn? Should they say, hey, look, it is what it is. We'll see if someone buys these assets, and as these buys the different, we're going to chop up the bank. There's going to be multiple different pieces. People are going to buy it. As we get more money, we'll start giving people their money back. Is that how they should move forward?
No, I think if you hit the discount window on this plan, if I was king, first of all, let me digress. Anyone who talks about Silicon Valley Bank, my suggestion on your spaces or anyone, ask Cuban how much money he has in Silicon Valley Bank, or his companies have in Silicon Valley Bank. Ask everyone who comments or asks for the bailout, ask them to disclose how much money they have in the bank, and then we'll find out what principles guide them. I have zero in Silicon Valley Bank. I could give a rat's ass about that place, and I would never, ever have a dime in that joint, just on principle. Now back to your question. If I was king, anyone who hits the discount window on this new plan, I would force them to raise equity to the tune of what they hit the discount window for. So if you need to borrow $1 billion or whatever, raise sufficient capital to keep yourself on sides to offset what you're borrowing, to get your company or bank fiscally sound. Don't, it's kind of a dual thing. Let it go.
They should raise equity, but one thing to know with the discount window is you have to give the money back. I mean, a lot of firms use the discount window is just a short-term loan. It doesn't mean that these firms are getting bailed out.
Okay, but here's my point. I agree. Short-term loan. Silvergate hit the discount window and they fell below
And
requirements.
they have to pay it back, and then they shut down.
Exactly. So whoever hits the discount window tonight or tomorrow to offset deposits, we both agree it's a short-term loan. We both agree that their NIM is going to get destroyed because there's penalties to this. They're going to have to pledge assets. The assets aren't worth anywhere near what they're on the books for, and they're going to have to raise capital. The raising capital for a stockholder is going to dilute the living fuck out of your
100%.
Okay,
100%.
So that is negative. So if everyone thinks that this is like